Welcome back, everyone. In today's episode of Portfolio Analysis, we're going to review the Q1 2021 results just published by Lazy Portfolio ETF. We're particularly interested to see if any of the portfolios in our annual challenge are in the top 10. Now, this specific data set is ranking portfolios based on returns, and here we prefer to rank portfolios based on risk to reward. But this data set is very interesting, so I hope that you stick around because there are some legitimate surprise results here. And, as a bonus, you'll get to see me eat a slice of humble pie. And then all the way down at number 74 and 75, we have the all-weather portfolio and the permanent portfolio. Both of these portfolios took a pretty bad beating, losing 3.7% and 4.4% respectively.
The period from 97 to 2001 is the only period on record where the value factor had a strong tilt toward quality rather than junk stocks. At the height of the dot-com bubble, the value portfolio had a sustained correlation of almost 50% with quality, something that had not happened before and has not happened since. The dot-com bust is seen as a triumph for value investing, and rightfully so, but we should also keep in mind how unusual that period was. Deep value investing was at that time able to buy high quality stocks at low multiples. That was a once in a career occurrence. Someone who became a value investor in the early 2000s expecting a repeat of this performance can be waiting a very long time before it happens again.
They're value companies for a reason.
Yeah, nobody wants to be a value stock. Nobody chooses that. That is the market imposing its will on these stocks.
Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. If you're new here, we have 3 ongoing series on the channel. The first is Portfolio Analysis, where we dig into long-term, mostly passive portfolios. The next is Retirement Planning, where we cover various financial independence and early retirement topics. And finally, we have Stock Secrets, where we dig into active management and trading strategies. As I record this video, it's currently April 1st of 2021. And at this time, the best performing portfolio in terms of raw returns for Q1 of 2021 is Paul Merriman's Ultimate Buy and Hold Strategy. I can't help but laugh here because returning viewers probably remember when I said this in December of 2020 about that Merriman portfolio. But that was then. And as we currently stand here in the first quarter of 2021, we can clearly see that this portfolio is a loser. I mean, look at these results. Well, I can't help but feel that that's just karma demonstrating the universal truth of what goes around comes around. In all seriousness, though, this is only 3 months of performance, which probably won't turn around 25 years of underperformance, but who knows? Maybe the ultimate buy and hold has hit a bottom, and we're actually at the start of a long bull market for factor-based strategies. Who knows? The best we can do is record the data and evaluate. Anyways, let's dig a little deeper into the portfolio data for Q1. We can see that the Merriman portfolio is here in the number 1 spot, returning just about 10%. Number 2 is a head-scratcher. We haven't covered this AGI portfolio, but it's a dividend growth strategy. It's fairly rare to see dividend strategies at the top of any best performer list. Of the portfolios that we've covered here on the channel, where did our portfolios place in Q1? Well, the version of the Simple Path to Wealth that doesn't have any bonds is here at number 6, and it returned about 7%. Number 17 is the Warren Buffett Family Trust portfolio with a 5% return. Number 28 is the Core 4, which returned just over 4%. Down in spot number 31 is that traditional Simple Path to Wealth. This is the one that's got 20% bonds, and it returns exactly 4%. And number 33 is where we find the Holy Talmud, which has returned just about 4%. Number 34 is the Boglehead 3 Fund, returning 3.8%. Down in spot 44 is the Larry portfolio, returning 2.8%. Number 46 is the Couch Potato, returning 2.4%. Number 53 is the Golden Butterfly, which just barely produced a positive return of 1.3%. And then all the way down at number 74 and 75, we have the All-Weather portfolio and the Permanent portfolio. Both of these portfolios took a pretty bad beating, losing 3.7% and 4.4% respectively. With treasuries and gold both doing so poorly, this isn't really all that surprising. At the very bottom, though, we've got long-term treasuries and gold as the worst performers of Q1 2021. If we evaluate the data based on sectors, we see that the energy sector is leading the pack with a great 31% return. That's followed by financials, industrials, materials, and real estate. Interestingly, the tech sector is still up nearly 2.5% on the year, even though CNBC is making it seem like there's the tech bear market going on right now. All the sectors are positive on the year at this point, so that's definitely a bullish sign. If we switch over to asset classes, leading the pack here is commodities, which I personally think is great news, since commodities have been in a bear market for the last 12 years. In November, commodities finally broke out, and it seems like they might actually sustain the breakout this time. Anyways, small cap returned about 13%, followed by REITs. Real estate was the only sector to lose money in 2020, so it's good to see real estate bouncing back. Getting absolutely annihilated at the bottom here is gold and long-term treasuries. The trend data is really interesting this year. Blockchain is leading the pack right now at 18%, followed by US infrastructure, global commerce, and self-driving EV. At the bottom of the list is clean energy and cybersecurity. I guess institutional investors don't think cybersecurity is important anymore because fewer people are working from home. I don't know. As far as individual nation performance goes, leading the pack is Saudi Arabia at number 1, with the UAE at number 2. The United States is number 17 below Italy, England, and Thailand, and just above Russia and Germany. And then finally, if we narrow our focus to just March of 2021, leaving out January and February, then our top 5 portfolios are the AGI, Aggressive Growth Income Dividend Portfolio at number 1, then the Merriman Buy and Hold Strategy at number 2, then the 100% stock version of the Simple Path to Wealth at number 3, number 4 is Warren Buffett's Family Trust, and number 5 is European stocks. The top losers again are long-term treasuries, the total US bond index, the all-weather portfolio, gold, and a different version of the permanent portfolio that we haven't yet covered on the channel. Okay, so what can we learn from quarter 1 of 2021? Well, I think above all else, we can clearly see a distinct rotation occurring from high multiple growth stocks into small cap and value stocks. There also seems to be a clear exodus from physical gold to digital gold in the form of Bitcoin and Ethereum. Further, one could even argue that income-conscious investors are rotating from treasuries and bonds into dividend stocks. I personally don't think that that's a very good idea, but that's a video for another day. This quarter is showing us clearly how last year's winners often become next year's losers, and vice versa. As for the actions to take regarding this data, I wouldn't recommend taking any action, to be honest. If you aren't already in value or small caps, then you already missed a rotation. Just keep buying each payday into whatever strategy that you're committed to.